All right, we have talked about credit card debt. We've talked about student loan debt. So let's talk about what is typically the largest amount of debt. Let's talk about home mortgages. We're going to talk about mortgage debt, or debt related to one's primary residence. For most people, most individuals and families, the largest purchase they'll ever make in their life is a home. The average home price in 2010 was $272,900. That number has dropped a little bit, although it's beginning to rise now as we get further away from the 2008 financial crisis. 62% of all Americans have less than $1,000 in savings. So for many, the American dream is home ownership, but it's not going to happen unless they're able to borrow money. It will take quite a while to save $272,900. So those people who argue that you should never borrow money, debt is always bad, debt is always horrible, then you're arguing that probably you're going to be a renter for a long time, which is perfectly fine. If you're okay renting the house, renting the apartment, then that's perfectly fine. But for most people, they like to own a home. There's that American dream of home ownership. The average homeowner carries about $172,000 in mortgage debt, and there is the total mortgage debt in the United States. That is an awfully big number. It's actually $8.37 trillion is the amount of total mortgage debt in the U.S. To put that in perspective, if we look at the two of the debts we previously talked about, student loans and credit cards, and we also throw in auto loans, those add up to $3 trillion, which is a little bit over a third of the total home mortgage debt. If you took all of the residential real estate, so all of the real estate where people live, houses, apartments, condos, and you found the value for all of those and put those together, the value for all of it would be $20 trillion. So we're looking at debt that equals about 40% of all of the land value in the United States, all of the residential land value. Before the 2008 financial crisis, that number was actually higher. It was at 65% of the total. So the financial crisis caused a massive drop in mortgages because people couldn't afford them and they went under, causing bank issues. So let's talk about getting that first home. Let's talk about what is required in that first home. And once again, kind of like how I talked about with credit cards, I talked about you can make smart credit card decisions that will be a benefit. These are make smart mortgage decisions. So this is what I recommend. You can ignore me at your own peril. Step number 1, look at your budget and determine what you can pay per month. I'm going to stop here and I'm going to read that again in case you weren't paying attention or you have Netflix on your iPad. Look at your budget and determine what you can pay per month. That is your first step. Your first step is not to go look at houses. Your first step is not to go drive around and to look at houses. Your first step is to see what is the amount of money that I can budget, that I can pay for this. Keep in mind your monthly payment's going to require property taxes. It's going to require homeowners insurance. It's going to maybe require flood insurance depending on where you live. In addition, if you own the house and something breaks, you've got to pay for it. So my step 2 says, when you're looking back at step 1, add 10% to it. Think about what your annual repair bill will be, add 10% and divide by 12. This is what you can expect your repair bills to be. Older houses are cheaper. They also may be more likely to need repairs than a new house. So you have to keep that in mind. So you have to look at this and say, okay, what is it going to cost? Once you get step 2 done, go back to step 1 and make sure that you are correct, that this is what you can pay per month. Step 3, go see a bank or a credit union and apply for a loan where the payments will not exceed what you calculated in step 1. I jump and yell and scream when people go to the bank and say, what's the most I can borrow? The bank's going to tell you the most you can borrow. That may not be the most that fits in, that payment may not fit into your budget. You need to focus on you and your budget, not what the bank will loan you. Go in and say, this is the most I can make in monthly payments based on my budget, not based on some preconceived percentages that they have, but based on your budget. And then say, okay, whatever loan amount you're telling me, what will the payments be, and will they be my amount or less? Step 4, go with a real estate agent and look at houses only in your price area. Don't do what those stupid people do on HGTV and all those stupid channels. If you can only afford a $150,000 home and you look at a $200,000 home, odds are you're going to like the more expensive one more. Probably going to like it about a third more. The reason why? It's a third more expensive. More expensive homes are typically nicer than less expensive homes. There's a reason why they're more expensive. I hate watching these HGTV shows where they say our budget is absolutely $300,000 and the realtor shows them, I know your budget's $300,000, but I thought you'd want to see this. It's $450,000, and the people end up choosing that house. That's the dumbest thing ever. Don't do it. Don't do it. Don't do it. They find the house. They fall in love with the house. They convince themselves, you know what, I can afford this house. I won't eat out as much. I won't do this as much. They buy the house, and then they get into serious financial distress. Don't do it. Don't do it. The real estate agent, there's a reason why they're showing you that $200,000 house. They get paid on a commission based on the value of the house. They're going to make more money for a $200,000 house than they will on a $150,000 house. So do what's in your best interest. The bank, they get interest based on how much you borrow. So there's a reason why they may say, here's the most you can borrow. Don't do it. Do what's in your best interest. Do what's in your financial best interest, not someone else's. So make these smart decisions as it relates to you. Step 1, budget. The first thing we started this semester was talking about budgeting and why it's important. It goes back into here. You've got a budget to see how much you can afford for your home. Next step, go talk to the bank and see, can you get approved for a loan where the payments do not exceed the amount you have budgeted. Once you get that done, then go look at a house only in your price area. If you let the real estate agent show you something outside your price area, then you're asking to get into financial difficulties. My wife and I, when we did the search, I knew exactly what we could pay. We were approved for that loan. I told the real estate agent, this is the most we will look at. Don't show me anything else. The real estate agent tried to show me something else, and I did not get out of the car. I told them, I can't afford this. I'm letting you know now I can't afford this. I don't want to look at this because I can't afford this. So take me away from this. If you can't, I can find a real estate agent that can. And amazingly enough, they found a house that fit into our budget. So sometimes you have to be very strong because you have to remember these people are getting paid based on the higher the value, the more money they get. Once you buy the house, once it's sold, they've got their money, they're gone. The bank, odds are, once that loan is done, they're going to turn around and sell that loan to somebody else, so they're off the hook. So the only people that are looking out for you in this is you, however you want to look at verb-wise. I'm sure I just made some English major twitch when I made that sentence. Be on the lookout to do what's best for you when it comes to looking at a mortgage.